Hey everyone, Jeff Dorman, CIO of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets, like we do every week. I'm joined this week by Ilan Solot from Merrick's, and I appreciate you joining me today. I think for those who don't know, I think Ilan has one of the best newsletters out there talking about everything crypto. So Ilan, thanks for joining.
It's always a pleasure. Thank you for inviting me.
Sure. And before we start, as always, quick disclaimer, this is not investment advice, but we're going to be talking about things happening in the markets. And everybody, in addition to reading Ilan's great write-up, if you subscribe to his, obviously you can go on our website, ar.ca/blog, and read That's Our Two Satoshis, which comes out every Monday. So let's talk about the markets, which unfortunately, even though this is a crypto talk, and we always want to talk about crypto, not a whole heck of a lot happening in crypto specifically because everything is being driven by macro right now. And I think even last week, gearing up to today's April 1st, tomorrow, obviously April 2nd, which is the big tariff showdown that everyone's been waiting for. You see a big kink in the options curve, both in the equity market and in the crypto market. Everyone's gearing up for something big tomorrow. It's a little disheartening, I guess I would say, that the entire digital assets market is now trading on nothing more than macro sentiment and Washington policy, regardless of sector. I think that statement will sound really foolish in a few years, since crypto by itself means nothing. It's just a wrapper that houses all types of assets in every sector. So saying that crypto is doing anything is going to sound really silly, because crypto by itself means nothing. It has to, actually matter what's inside of it. But specific to what does exist inside of crypto wrappers today, it makes even less sense that we're keying in on tariffs, since by definition, crypto is probably the only industry in all of the financial markets that's not affected in any way, shape, or form by tariffs. I mean, which digital goods are being taxed right now? Is Ethereum taxing Solana, or what's the? I'm floored, I guess, right? I mean, in fact, most of the businesses in crypto are actually pretty recession proof, right? In the sense that they are, probably more loyalty rewards cards than they are, revenue producing entities that are affected by, employment data and stuff like that. So I don't know. I'm a little baffled, I guess, by how did we get here? How did we get to a point here where all crypto cares about is what's happening in macro?
Yeah, there's no direct answer to this, but a few different ways to slice it. I mean, first of all, I just want to add that it's kind of add insult to injury. The fact that gold is performing so well in this period just kind of makes. I think it just takes out another one of the arguments of the crypto industry at a particular time, which would have been great if we saw gold and Bitcoin, for example, have more or less a similar behavior. So it complicates the argument. But I think where we are now is a lot of a function of a state of development of crypto. And I think that this particular cycle is really about integration into developed markets and to TradFi in general. Many of our clients are big funds that are experimenting with crypto for the first time. And I think especially in anxious markets, it becomes more of a portfolio effect element that in a sense that you have to cut risk, you cut indiscriminately. And all the nuances that you pointed out, in fact, your two Satoshis is fantastic. I read that one just yesterday. And all those nuances get lost, I think, in a moment of risk aversion. I think in the future, as you said, crypto will feel very different than it is today. But at the moment, this is what rules the day.
Yeah, I think the risk aversion thing makes sense clearly. But if you think about it that way, this is where I kind of think market structure really is a problem in crypto. And I've been pretty vocal about blaming Coinbase and to some extent Binance and others, in the sense that they just really have failed to educate the investor base. Meaning, like, why are we catering to macro investors and fast money traders on just meme coins and Bitcoin, instead of catering to the majority of the investors in the world who care about cash flows and revenues, who would love to hear about DePIN and DeFi and other areas that actually look and feel much more like stocks and bonds. It's just crazy to me that the majority of the world's wealth cares about stocks, bonds, and real estate, yet here crypto is making all of their focus and energy and time on a meaningless sliver of the investment world that a handful of CTAs and macro traders care about. So I think that's just weird, first of all. And I think that's a big reason why crypto has gotten lost in this macro shuffle. But the other part of what you're saying, though, about just de-risking in general is interesting too, because clearly, look, tech stocks are getting hammered, AI is getting hammered, and obviously there's a big overlap there with crypto. So that makes sense. but that would imply that like every investor has, 50% of their investments in equities, and maybe 20% in real estate, and 20% in bonds, and 5% in commodities, and maybe 2% in crypto. And then when things get tough, they cut crypto first because it's the lowest quality, most volatile. And that would make sense in a risk-off environment. Like if that was just, it's kind of no different than if you're a bond investor and you have corporate bonds across your entire portfolio and things get dicey, the first thing you cut is the triple C stuff, right? Or if you're an equity investor, the first thing you cut is like, your ancillary trades or your super high, flyer, low profit companies. What's weird about crypto, though, is I just don't see a lot of TradFi funds really having that much crypto exposure that would be the first thing they cut. The majority of crypto people are kind of just trading crypto, and they just go 100% long to 0% long overnight, right? There's not really a lot of just balanced funds that are like, I'm going to cut 10% of my crypto portfolio and I'm going to focus on the most risky stuff, meaning like memes or AI, but I'm going to keep all of my Bitcoin or ETH or Sol or DeFi or some of the more established stuff. You just see this whole student body left, student body right trade. And again, you're not wrong to say that when markets go risk off, they're going to cut risk, but it's just, again, weird that risk that we're talking about is tariffs and NFP, jobs data, when it just has such little to do with what this market has evolved into.
Yeah, no, I agree. The thing is that again, I go back to the fact of the immaturity of the market. Even those who do have multiple assets in a balance sheet, and you think about like large U.S. retail investors or some funds that are dipping their toes into crypto, they have this disproportionate impact on the market because the market is largely lacks liquidity at this point. And on top of that, I think you have a lot of momentum-driven trades. Crypto has become a very useful tool, especially over the weekends, to trade risk-off moments, and that just reinforced the cycle. So even though, as you said, you're conceptually right, it turns out that even the small proportion of players who do play this game, and I do not think is a majority of them, can disproportionately impact the market, and it just drives the sentiment, and the markets gets kind of trained into this. No, and furthermore, I think that unfortunately, Trump really reinforced a lot of your points of what you said, is like why the attention is focused on meme coins and so forth. That despite all the underlying, I think, very positive regulatory agenda that's happening on the surface, like I remember I was in a conference when the Trump and Millennia coins came out, and these guys are completely non-crypto related. They swarmed me and they're like, what is this? And I think that really kind of reinforced that view of highlighted that speculative side of it. And in many ways, as a friend of mine said, it kind of kneecapped Bitcoin's chance of maybe being a different kind of asset this cycle, because it just drove that association. This is kind of just a speculative asset. And very early in the cycle, people just got that ingrained from the Trump act. So it's unfortunate because the underlying is very positive. If they could see that, that would be a different story. But the headline is so emphatic on that side. And
you talked about the front running kind of as well, and about crypto being used as a trading vehicle. We saw an interesting pattern last weekend too, which I thought most of January and February, we saw a lot of Sunday news, meaning like a couple of tariff announcements happened on Sunday. You had the DeepSeek freak out happen on a Sunday, and crypto markets were obviously open when other markets weren't, and they saw the brunt of that selling before equity markets opened, and then the equity markets kind of followed suit to what crypto was doing. This last weekend felt different to me. This last weekend was actually the opposite, in my opinion, which was the equity market felt weak all week and certainly into Friday. And as soon as the equity market closed on Friday, you immediately saw crypto get hammered, almost like it was an extension trade. It was almost like people had more selling to do, couldn't get it all done during U.S. equity hours, so they decided to hammer crypto over the weekend. And then on Sunday night, when equity futures actually opened, they opened down, but crypto didn't go down any further because crypto had already gone down, and then actually held the levels when U.S. equities opened down 2%. And
it was leading actually, and then it was bounced afterwards.
Exactly, and then ultimately when Monday happened and equity markets actually shot right back up, crypto followed to some extent. So to your point, it's a small number of funds and folks that are actually using crypto this way, but it's having disproportional results on the market because, again, and I will blame Coinbase and others, that they've done nothing to educate and nurture the secondary market. When you spend all of your time as an industry nurturing to fast money traders and venture, and you do nothing to educate on real assets and develop real fundamental managers or real stickier kind of investors, that's what happens. A very small number of folks can disproportionately move the market. And look, the same price action that we saw in November and December on the way up is the same price action we're seeing right now, which is what happens when there's no secondary liquidity.
Yeah, yeah. And also tying both the exchange, let's say ethos or modus operandi plus this disproportionate impact, there's the concept of leverage, right? Because I mean, there's possibly too much leverage for such a immature market going around in exchanges, and and both centralized and decentralized exchanges. So I think that also causes this disproportional impact of small players moving around, and you get this situation. So it's unfortunate. I think it could have been a bit different. I can imagine many scenarios in which we'd be having a very different conversation here, but it is what it is.
Well, look, I mean, I'll stay on the Coinbase thing just because I think it's interesting. Like, Coinbase has $10 billion in cash, and the equity market gives them zero credit for anything that they're doing, because if you look at the last 5 years of Coinbase, they've made a bunch of acquisitions that have amounted to nothing. They have bought back their own zero coupon debt, which is a baffling decision. They've bought back their own stock. They have made massive venture bets that the equity market gives them zero credit for, and ultimately their customers should hate them for, because it just means more tokens they're going to dump on their heads. They've done nothing to improve the secondary liquidity and secondary market. What happens to Coinbase in the future, sticking on that? Just in the sense that you've got Robinhood basically taking over all their retail flow. If you just look at a stock price of Robinhood versus Coinbase, and they were basically identical stock prices for most of the last 3 years until the last 6 months, where Robinhood is just crushing Coinbase on everything involving retail. Meanwhile, on the institutional side, you've got JP Morgan and Goldman and everyone, Fidelity and everyone else gearing up to take over. What is the future for something like Coinbase when you see what's happening?
Yeah, I mean, arguably, their development of the base chain was very successful, and even though there's a lot of back and forth about the impact on Ethereum, but that's more extended to the entire L2 ecosystem. But nevertheless, I mean, a chainless, a chain without a native token to be as successful as Base was, I think this was a pretty good hit for them. And they also carved out a significant custody business for the ETFs. So I think they have a few good places to pin their future on. But I have to admit that, as you said, they're going to face a lot of competition. And I think now in the US, seems like there's a lot more interest from other exchanges to try to carve out space there as Trump is in power. So I think they're going to face competition, not just from Robinhood, but from other. Binance US is trying to grow. So I think it's going to get very competitive, the exchange space. And they tried to launch their futures business as well. And now there's this talk about the Deribit. So I mean, there's a lot happening there. But I think generally you're right. I mean, they're going to face a lot of competition, and I think it's been hit or miss for them.
Yeah, I wonder if those guys, like you mentioned, Coinbase, Binance, Kraken, obviously they're going to try to IPO. Mm-hmm. I wonder if they had done more to educate and support the secondary market, if they'd be in a much different footing. But anyway, let's talk about kind of ahead here. Like we mentioned, tomorrow, April 2nd, kind of D-Day on the tariffs. You have the employment report on Friday. A lot of huge moves across equity markets in terms of bullish to bearish sentiment. I mean, we went into this year with probably the most bullish outlooks ever, and then everybody flipped to bearish in the last 4 weeks. What do you think happens over the next week here? Do you think ultimately some of this negative sentiment continues? Do you think it sort of maybe gets, maybe this is a nothing burger and is already based in and you're kind of off to the races again? You got desks like Goldman putting out massive rate cut projections all of a sudden, basically implying a massive recession coming. Like, if we're going to be forced to just trade macro, what do you think about the macro landscape?
So as I wrote this, or was it earlier this week, I think? And I think that the big macro question right now is whose put is closer in the money? Is it the Fed's or Trump's, basically? In other words, different way to phrase is who's going to blink first, or who's going to soften up their posture first? So on one side, there's the Fed, who could, as you said, Goldman and others already kind of forecasting a deeper recession, and they could expedite cuts or become more aggressive in the language. Which would be the Fed put, so to speak, or let's say if the markets really collapse, maybe the Fed will have again, interventions of intermeeting announcements, all kinds of stuff they can do, or it will be Trump starting to soften a little bit his rhetoric and his his negotiating tactics. And I am siding towards the Trump more likely softens before the Fed. And I think this is what we're going to see. Perhaps it was a little bit early, but since last week, I've been saying that I think the risk reward has shifted pretty dramatically in terms of what's priced in for the tariffs, and I think it's shifted to the positive side. And we saw a little decent recovery today, and I think it's impossible to know what's going to happen. But I think he's fighting far too many battles at the same time, both kinetic, economic, political, social, judiciary battles. So I think it's a lot on his plate, and I think his tactic is to front load, which is smart. Front load in the beginning of the mandate, all the difficult stuff. But I am thinking that his pain threshold is not that much further out. So my guess is that he starts to soften. I don't mean a dramatic U-turn, but just going somewhat softer than what he's saying now. And meanwhile, the Fed, I think Fed has a lot more degrees of freedom because there's a lot of fog of war. Now, the impact of tariffs is definitely ambiguous. Oil is still kind of creeping up still. Yeah. So I think the Fed has a lot more, and they're starting from a relatively strong economy. So I think the Fed has a lot more space to just stay course. And I think the pain will come on the Trump side first.
Yeah, I think betting on anything Trump does is really kind of a fool's errand. Yeah. It's so hard to anticipate. I do tend to probably agree with you on the Fed side. I guess I would caution, and this is where I think investors need to study history a little bit better. Like, the Fed cutting rates is usually not a good thing. Like, if you actually look at equity market performance versus Fed cuts and hikes, equity markets do really well when the Fed is doing nothing and when the Fed is actually raising rates, right? Because they're usually raising rates for a reason. It's because the economy is good and they're actually trying to prevent it from overheating. It's going that well. When the Fed's cutting rates, it's usually because they're late to the party and things are already pretty bad and markets tend to go down. They eventually recover after the Fed has cut, a couple hundred basis points over a bunch of cuts. But seeing more rate cuts in the future is not actually good for the market. That's a bad thing. You hope that Goldman is wrong. You hope that there's actually less cuts this year, or maybe there's just a random sporadic cut here and there, not a series of cuts. It would definitely not be a good thing if you see, 4 or 5 cuts or, over the course of the next couple of years because the economy is in a recession. On the other side of things, though, I would tend to agree with you that I think, again, the market has flipped from bullish to bearish so fast. I mean, the equity market had the, what, third or fourth fastest sell-off in history of 10% or more. And you're just not really seeing the recessionary pressures that everyone's freaked out about. Like, if you actually look and parse all the economic data, anything that is sentiment or survey-based is in the gutter. Anything that's actual data-based is totally fine. Like, the jobs data has been totally fine. The PMI data has been totally fine. Manufacturing, credit spreads are totally fine. Even the 50 or 60 basis point widening that we've seen over the last 3 weeks is just in line with the amount of treasury yield tightening that we've seen. So absolute corporate yields are unchanged over the course of the last 6 months. Like, you're just not seeing a whole lot that backs up these recessionary fears other than fear itself. So I tend to agree with you that, this week will probably come and go. And most likely you probably have a little bit of a relief rally, if nothing else, just because there's been so much angst built into this. Yeah. I find it hard to believe that you're going to see any meaningful negative news that already isn't baked into the market based purely on the tariffs and the NFP data itself. Which again, with how offsides everyone has, without how offsides everyone is on the equity market and really how just flat to no risk everyone is in the crypto market. I mean, you certainly are setting yourself up for one of those, pretty big dramatic rallies, even if it's not sustainable. Just based on, again, every single dealer in the crypto market and in the equity market is just pitching straddles around April 3rd right now. It's like, just bet on volatility. Volatility is going to happen. It's like, really? Maybe not. We just had a pretty massive sell-off deleveraging over the last 4 weeks.
That's what I was going to say. Volatility is more likely to happen if you're starting from a highly leveraged point. You can have like cascade liquidations or something like that. But it doesn't. I think now it's more of a situation which we could be seeing kind of a tradable bottom here, in which you start seeing a bit more. All Trump has to do is not escalate dramatically, and in my opinion, I think he will even have a little bit of some hints of softening a little bit. And if he does that, I think that's all you need. You're going to have, obviously, as you said, initial risk on recovery, but I think you could sow the seeds for like a more stable sentiment to start growing a little bit. And I think that's not a bad place to start building. But as you said, forecasting Trump is losers. loser's game for sure.
Ilan, I know we're bumping up on time here. I appreciate your insights as always. I certainly recommend anybody who can and has means to looking up Merrick's Digital and getting some of Ilan's thoughts. But where can people find out more about you or your firm or any of the insights you have in the markets? Because again, I think it's fascinating the way you think about risk and about the individual components of the crypto market.
Yeah, so we have an open list through Mark Solutions. You can find it. It's probably easy just find me on Twitter. It's isola at gmail at isola for Twitter, and you can from there you can find all the links and the publications, or LinkedIn is there. So
great. Well, thanks again for joining. We'd love to have you back.
No, it's a pleasure.
And for this week, guys, that's our 2 Satoshis. Check out the blog on our website, ar.ca, and we'll be back again next week. Thanks, everyone.